I've been investing in ETFs for 10 years, and honestly, the returns haven't been that great. Especially with my very first ETF, I really left a lot of money on the table. Which ETFs I've been investing in over the past 10 years, how the returns, the risks, and my strategy have developed, and exactly where I stand today down to the euro and percentage point with my ETFs. You'll find out all of that now on Northern Finance.
Hi, my name is Alex from Northern Finance. This video was translated with the help of AI so that we can reach more people in their own language. A native speaker has reviewed the translation. Still, some sentences might sound a little unusual. Thanks for being here and enjoy the video now.
My name is Alex Black. Yes, today I'm going to show you exactly how much I've earned with my ETFs over the past 10 years, down to the euro and the exact percentage point. And investing is a wonderful thing, to use the wording from the book The Richest Man in Babylon. Every coin you don't spend and save is essentially like a slave of yours, literally working for you constantly, around the clock. And while many people today would likely use somewhat different wording, you have to admit it really does hit the nail on the head. Money that you manage to save once and do not spend again on consumption continues to work for you. And it brings you steadily closer and closer to your goal of enjoying a good retirement, or even achieving financial freedom, step by step. When I bought my first ETF 10 years ago, it was the Lixor MDAX ETF. Today, it has been renamed the Amundi MDAX ETF, costs 0.2% per year and manages 217 million euros. According to the fact sheet, the largest holdings today are Lufthansa, Talanx, Nemetschek, Sartorius, Hensoldt, Renk, Knorr-Bremse, Porsche, Leg Immobilien, and Delivery Hero. Yeah, so I'd say those aren't bad companies at all. When I bought the ETF in 2015, my goal wasn't to become financially independent like it is today. I just found it interesting to invest in Germany. Yes, it's my home country, and I wanted to take my first steps toward growing my wealth. I didn't invest much back then. Yeah, I set up a savings plan for 50 euros a month because I had just finished school, was only 18 years old at the time, and had just started university. I just didn't have much money back then, honestly, but everyone has to start somewhere, no matter how small. And I got started. Back then, I received child benefits from my parents as well as a little extra from them each month. That was about 400 euros. And on top of that, I had a student loan from KfW Bank, which gave me another 400 euros per month. So altogether, I had 800 euros available each month for rent, food, and all of my other expenses. And my savings rate was 50 euros or 6.25%. Of course, student loans aren't actually really income, but I wanted to get into the habit early on in my financial journey. Today, my total assets are around 455,000 euros. Yes, after the recent crypto crash, it's a bit less now, and ETFs make up 36% or 164,000 euros. At this point, I only have 2 ETFs left in a global portfolio strategy, the iShares Core MSCI World and iShares Core MSCI Emerging Markets, as I mentioned in the last portfolio update. Since 2022, I have been investing in both ETFs every month equally at a 50-50 ratio. But since the World ETF has historically delivered higher returns than the Emerging Markets ETF, I now have 91,000 euros invested in the World ETF, and I just let it run without doing any rebalancing. And the MSCI Emerging Markets is only at 71,000 euros because it simply hasn't performed as well. Until recently, I also had other global ETFs from Vanguard, but I wanted to tidy things up and only use accumulating ETFs from now on. Yeah, I actually don't need the dividend payouts yet. I'm still more in the growth phase, so I prefer it when everything is reinvested automatically without having to do it manually, because I would do it anyway. So that's what things look like today. But how much return have I actually made with this? To be completely honest, at the very beginning I really messed up quite a bit, and now we're using the free back testing tool from Curvo as well as the free tool Portfolio Performance, which I personally use to track my actual wealth. Here we've added the Amundi MDAX ETF to Curvo, which back then was my entire savings plan at Comdirect. All my 50 euros went into this, not into any other ETF, and that was it. I thought I could potentially achieve higher returns with mid-cap stocks than with the large cap stocks from the German DAX, the so-called first tier. Because while the DAX index contains the 40 largest German companies, the MDAX includes the next 50 largest companies. That means places 40 to 90. And now let's first open up the settings and carefully adjust just a few things right now. First, we need to set the starting point to January 2015, when I actually started investing in all of this, and then in the middle set up a savings plan instead of a one-time investment. I invested 50 euros every month, but I actually didn't really keep it up until today. Unfortunately, you can't set an end date, but well, that's just how it is now. But for the calculation now, it's still enough. There were also small transaction costs back then. There weren't any free savings plans like there are today. It's maybe like when Grandpa talks about the war. Yeah, for some people, they're only used to free savings plans. But it wasn't always like that. I'm also entering the ETF's costs. And then we have this chart. At its peak, my €50 savings plan reached €5,530. Then there was a crash and it dropped to €4,000, and now it's at €7,430. So I would have paid in €6,350. But as I said, I did this until 2020 and not after that. But you just can't set it up that way. But that doesn't really change much. Because as you can see, that way €6,350 were invested. And after 10 years, that turned into just €7,430. That corresponds to an annual growth rate of a ridiculous 1.52%, or in other words, basically nothing considering the risk of stocks. And that's before taxes and inflation. Yes, if you also consider the volatility at 16%, a fixed deposit would have been the better choice. Here you can see the annual returns, and we notice that there were surprisingly few years with double-digit returns. Although there was a positive return in 6 out of 9 years, in the end, there is almost no profit left. Here we see the impact of inflation and how much purchasing power we actually have. Because in real terms, we only have 5,500 instead of 7,430 euros, and the actual growth rate is even negative at 1.37% per year. And even this figure might be too optimistic, because personally, I experience much higher inflation in my daily life than the official numbers suggest. The real return is likely to be even a little bit worse in the end, maybe minus 3 or 4% per year. So this really wasn't a good investment. We can also see the drawdown here, that is the maximum loss during the crash. And below we see a forecast of how the portfolio might potentially develop. So, as I mentioned, I only put my €50 per month into this particular ETF between 2015 and 2020. And after that, I didn't invest in anything at all for 2 years. Yes, I kept the whole thing, but I moved abroad and my company needed the money more urgently than the savings plan did. So that's where I put it instead. By 2022, I was back on my feet financially and able to save a lot again, actually a record amount. And because of the poor results from that first ETF, I changed my approach and started using the World Portfolio Strategy. I didn't want to be so dependent on Germany anymore or on Europe either. So starting in 2022, I began using my World Portfolio Strategy at a 50-50 ratio. Most people invest 80, 20 or 70-30. But if you actually weight it by GDP, the ratio would be 60% developed world and 40% emerging markets. Not by market capitalization though. But there are different ways to look at it. I simply wanted to overweight China, Brazil, Indonesia, and other emerging markets a bit because the US has historically delivered extremely strong stock performance. And personally, I believe that over a very long-term horizon, 20, 30, 40 years, the US, as of today, has already seen its best days. And that's why I didn't want to invest quite so much in the US. After all, as of today, the US makes up 72% of the MSCI world. It's more like an MSCI America with a bit of the rest of the world added in. The S&P 500, as the largest stock index in the American market, has also become extremely expensive in my view, with a historically high price-to-earnings ratio of more than 28. This means that today you are actually paying for approximately 28 years' worth of earnings from the included companies in order to purchase a share. And as you can also clearly see in the chart, this is a record value that we've never reached at any point throughout history. You really have to let that sink in. Whenever we were at similarly high levels in the past, it was always, truly always, followed by a long-term correction downward. Even if we look back more than 100 years, that is really significant. And on the other hand, you could also say that more money is being printed today than ever before in the history of the United States. And that's why higher valuations have to follow. That's true as well. But still, stocks and stock ETFs are in fact actually very expensive right now, especially in America. That's why I simply want to be diversified and not put so much money or most of my money into the USA, even though it will still make up a large part of my portfolio. In my ETF portfolio, the MSCI World makes up 55%, which gives me a US allocation of exactly 39.6%. That works for me. The world doesn't revolve only around American companies, even though they are very strong globally in many areas. The competition, especially in emerging markets, isn't sleeping. In fact, in many cases, they're already ahead, in my opinion. Okay, that's enough about that. Let's take a look at the bare numbers. Here we have the tool portfolio performance, and I've been tracking my portfolio with it since January 2022. To the exact euro, and as shown by the blue line for the ETFs, I started with €0. I saved my first 1,000 euros, and by the end of the year, I had invested 30,000 euros in my new world portfolio strategy. A year later, we were at 61,000 euros, another year later at 111,000 euros, and today, on December 3rd, we are at 164,000 euros. There were also some periods of loss, like at the beginning of this year when we dropped to 104,000 euros during the crash. Shortly before that, it was around 120,000. But that's just how it goes. What's especially interesting now, of course, is the capital gain called delta, which is represented by the green line. After 2 years, I had a capital gain of 2,833 euros. In the first year, it was actually still a loss of 1,562 euros. 2022 was simply a bad year for the stock market, and 2024 was all the better, you have to say. And the profit was 18,600 euros. And today we are at 30,800 euros in unrealized profit. So that's how the last 4 years went with the global strategy. But those are just the euro values, and I saved quite a lot. That's why we're now going to take a look at the percentage values as well. Here we have my ETF view in portfolio performance. I created this view recently, and since January 2022, I have achieved just under 7% return per year, or a total return of 30% with ETFs. Here we can see the annual returns, and as mentioned, 2022 was a bad year for the stock market with almost a 10% loss. Nevertheless, the overall portfolio was still up by 2.4%. In 2023, ETFs performed very well, phenomenally well in fact, with more than a 20% return. And so far in 2025, they are also doing really well with 8.8%. This has often been clearly reflected in the performance of the overall portfolio. Just not this year, since Bitcoin is currently performing poorly in my overall portfolio. Here we can see the returns per month sorted again. And the ETF portfolio has achieved just under 7% return per year, while the overall portfolio has done a bit better at 9% per year. Of course, this fluctuates, as you can see right now. These are live values with my real numbers and real prices. In the long term, I'm not quite satisfied with the 7% return yet. Yes, there's still a bit more possible, but it's already good, I would say. And everything is moving in the right direction. Finally, I want to show you the development of the returns over time, also in comparison to the rest of the portfolio. Here you can see everything at a glance since January 2022. The overall portfolio shown by the black line is at 39% return up to today. And peer-to-peer loans shown by the green line are actually performing a bit better than the ETFs. I didn't expect that. The iShares Core MSCI World is represented by the light blue line and the iShares Core MSCI Emerging Markets by the red line. This ETF performed significantly worse, especially in 2024, but in return it has done much better this year. Here we've climbed from 5% to a total return of 20%. And with that, I'd say let's draw a conclusion. As we've seen, betting on your own country, a specific sector, or many other things such as investments can simply go wrong. Yes, even a Nasdaq ETF might not perform well for a few years, so that shouldn't be your only strategy. For me, the world portfolio strategy works so well for a reason, and it's not popular for nothing. Because if, in the very long term, over 10, 20, 30 years or more, the global economy doesn't do well, and let's assume it doesn't grow, and the ETFs don't grow with this strategy, then we'll have much bigger problems than the performance of our ETF savings plan. And in that case, it's okay. In the long run, the return should be somewhere between 6 and 9% per year. With just under 7% at the moment, we're right in that range. If you want to invest long-term with a broker, I can recommend Freedom 24. Here, you can trade worldwide instead of just in Europe at low cost, and you regularly have the chance to get free shares worth up to 500 euros, as is currently the case. This applies to both new and existing customers. The link is in the video description below, and I'm personally very curious to see how things will go with my ETFs, and I hope you were able to learn something from my mistakes. And if you found this interesting, please leave me a like and subscribe, because I publish a transparent portfolio update every month where I show everything, all purchases, all sales, all returns, all interest, and so on. And to finish, I want to say something very important that many people often misunderstand. The right ETF with supposedly higher returns probably doesn't actually exist. It also probably won't make you rich, even if there are some new products. Let's just put it that way. Beating the market in the long term is very difficult, especially if you don't take on significantly more risk. If you really want to build a lot of wealth, you simply have to earn more yourself and then invest more. That's the biggest lever you can control. I'm not a brilliant investor either. Yeah, I'm far from it, but I earn decent money, save a lot of it, and personally handle it wisely. And in my opinion, that's the key to building real wealth even with ETFs. With that, I wish you good returns and see you next time.